Hello and welcome back to Core Finance with me, Matt Brown. I'm joined by Shaun Richards, who is from Not a Yes Man Economics. How are you today, Shaun?
Good, thank you.
Well, thank you very much for coming on today. Something that's obviously, well, we look at the front of City AM and a lot of the other financial press, the fall from grace of Provident Financial, a FTSE 100 company, huge drop yesterday, I think it was about 60%. I'm trying to remember going back, and that's going back about 20 years, looking for a FTSE company that has dropped that much in one day. I think RBS and maybe Marconi back in the day. Bit of a shock, really, for the market.
Yes. I do remember the Marconi episode, actually, which in some respects was even more back in my day. They were a big investor in short-dated UK gilts because they had so much money and they had to put it somewhere, and then suddenly for something like that to go bang was a thing. But if we move to Provident Financial, in a way, I think there are quite a few implications here, because if we look at this week, which will be on Friday, central banker story, Jackson Hole was looking at things from America, Janet Yellen, Europe, Mario Draghi. But if we focus in on the Bank of England here, this poses a lot of questions. Mm-hmm. What has been its policy since particularly the summer of 2013 when it started the funding for lending scheme? It's encouraged this sort of thing. I've written a lot about the way the money went into the mortgage market, other types of lending. Mm-hmm. It had another go last August, cutting interest rates and also more QE, then the term funding scheme. And we've seen money splush around into all sorts of areas, unsecured lending. Now suddenly we see a place that specialises in the far end of unsecured lending, mm-hmm. subprime, yes. hitting trouble. And if we move to the specific case of Provident Financial, what we also see is that it's so different to only a month ago. I looked up both reports as to what it said, and it was, okay, we've had a bit of trouble, but it'll be fine. Mm-hmm. We'll make 60 million. Suddenly we'll lose something between 120 and 160 million, I think, if I remember the numbers accurately.
Yes, there or thereabouts, yep.
And so that's a big shift. And this is very, very familiar from any sort of finance organisation that hits trouble, which is they drip feed out the bad news. So in my mind, there's usually a lot more than two of those.
Mm. I mean, it's interesting when we go back 10 years and we look at, say, Northern Rock, and there was a problem with the system, and it was the LIBOR and it was the lending market. There was fundamentally problems with the system. So certainly with Northern Rock, we saw contagion. Now, in the case of Provident Financial, is this an isolated incident in the sense that the operation, there were problems with changing the way that the debts were collected from door to door, moving from a self-employed model to a full-time model, or does that mask a bigger problem with this whole subprime lending market?
I think both, actually. I'm sure that they had technical issues in their switch, but also there are other areas where we've seen sort of flickerings of warning, something that I've looked at a lot, the car loans market. Yes. What was Ford doing, as it happens on the same day, mm-hmm. announcing a £2,000 scrappage scheme. Now in another form, that's a price cut. Mm-hmm. How you get money across to people without saying it's a price cut. These days, I know, fascinatingly, it comes under the sort of green banner. Oh, we're going to help the environment, price cut. And so that hints at trouble there. And this is a subset of this, and this is where the Bank of England, usually when this happens, proves to be very leaden-footed, which if this happens, it'll be elsewhere. What I mean by elsewhere is there might be troubles for RBS and Lloyds here, but for them it's likely to be small fry. Mm-hmm. But these sort of smaller lenders hitting trouble, I can't think we've really seen that since like the 70s, the famous Slater-Walker episode, before my time in that sense, before someone makes that joke. But that was a thing of where these things can spiral out and then cause trouble further down the line in that there's so many of them. And there are signs of as I said, we've had a big boom in unsecured lending. Mm. There do seem to be signs of people paying less. So what happens then? How does it step in?
I mean, do you see, say, the FCA stepping in and the Bank of England at some point and restricting the amount of lending? Would they be better served having preemptive measures than trying to react to the outfall of if something did?
Definitely.
Did happen.
Definitely.
So they need to be on the front foot and look at this and maybe not look at it as an isolated incident.
Definitely. I think we should be doing that right now. Because I saw people saying, oh, it's fine that the FCA was going in yesterday. And I thought, well, yeah, but there's just been a 2/3 part of it. It's already too late. Mm-hmm. Now, I understand that they, like say what happened with RBS, they probably weren't told the truth either. But when these things happen, there's sort of acceleration of central banks and regulators needs to be almost infinite. You've got to be straight in and on with it. Because in the scheme of things, this is quite small, but we've seen these things before whereby suddenly then, oh, me too, oh, me too, oh, me too, and then it can be disturbing. And it's not as if there aren't other sort of flickering warning lights around the system. Best to act when they're yellow lights rather than red.
Understood. Well, on that note, Mr. Carney, if you're watching, take note. Thanks very much, Shaun.